Hey everyone, welcome back to Corporate Decoder, the place where we dig into the numbers so you don't have to. Today we're cracking open Clarus Corporation's latest annual report, and let's just say it's a bit of a bumpy ride. We're going to see some serious challenges ahead, a bit of legal drama, and a major strategy shift. Clarus, if you don't know, is the company behind brands like Black Diamond in the outdoors and Rhinorak for your car. They sell all sorts of gear to help people enjoy their outdoor adventures. This report is their Form 10-K, their annual check-in with the Securities and Exchange Commission that covers the year ending December 31st, 2024. First off, the big picture is that Clarus designs, makes, and sells outdoor equipment. They're all about those enthusiast markets, selling Black Diamond, Rhinorak, MAXTRAX, and TRED outdoors gear. They go through your typical outdoor retailers, online stores, and even directly to manufacturers, hoping for long-term growth in the outdoor sector. Okay, so right off the bat, Clarus has been busy. They bought Rocky Mounts, a bike rack company, last December. But that's not all. Earlier in 2024, they sold off their precision sports segment, which included Sierra Bullets and Barnes Bullets. This looks like a strategic move to refocus the company, so they can double down on the outdoor adventure market. Financially, it is worth to note that because they sold Sierra and Barnes Bullets, the numbers from that segment are separated and reported as discontinued operations. This impacts all the results we're about to discuss. Keep an eye on the impact to net income. Looking ahead, Clarus believes they're in a good spot due to a few key trends, including more people getting into outdoor lifestyles and health, as well as the rise of overlanding, which is combining off-roading with backcountry camping. There is also climbing is becoming more popular, which is expected to benefit Black Diamond. One of their major strategies is international growth. They feel Black Diamond can be a bigger player in Europe, and Rhinorak has huge potential in the US, Europe, and Asia-Pacific regions. They are also looking to buy complementary businesses to grab new products, customer bases, or to deepen the penetration of their existing markets. They anticipate financing these acquisitions through a mix of cash, operating cash flow, and potentially even tapping the capital markets. What are some competitive advantages? They feel they have strong brands and innovation. Black Diamond, Rhinorak, MAXTRAX, and TRED are supposedly iconic. Also, they have a history of product innovation with all the engineering and technology to back it up. It should be said that insiders own approximately 22.2% of the company's outstanding common stock, which should be aligned management incentives with shareholders. The company operates within the outdoor segment with Black Diamond Equipment and PIEPS. It is a global leader in equipment and apparel for climbing, skiing, and other activities. The adventure segment manufactures automotive roof racks, trays, carriers, bicycle racks, and accessories with Rhinorak, MAXTRAX, and TRED. Note that financial information regarding our precision sports segment is now classified as discontinued operations. The filing then dives into a wide range of potential risks, which is important. They range from risks related to the industry to the business and financial structure. This is where it gets interesting. First up, risky products, product liability, warranty claims. A big one is their avalanche beacon transceivers. Since many of Clarus's products involve risk, they could be facing lawsuits. They maintain insurance, but claims might exceed coverage. Also, there's a U.S. Consumer Product Safety Commission investigation going on, which could lead to penalties. There is no product recall insurance, and its warranty reserves may not cover all claims. This investigation by the CPSC, the federal government agency that keeps unsafe products out of American homes, is related to the products through BDEL, Black Diamond Equipment Limited. The commission is investigating BDEL reporting obligations under the Consumer Product Safety Act with certain avalanche transmitters. It involves whether the transmitters unexpectedly switched out of send or search mode. Federal staff has recommended substantial civil monetary penalties, and the Department of Justice is doing its own investigation. What could happen if the CPSC imposes substantial civil monetary penalties, or there's an adverse outcome with the Department of Justice? That could be costly and damage the company's reputation, which could materially affect the company's liquidity, stock price, financial condition, results of operations, and/or cash flows. The company can't estimate the amount and said a future estimate change could be material. The CPSC probe is not the only risk. There is reputational issues as a result of claims that the company's products or any of its key employees, endorsers, or suppliers could seriously damage its reputation. There are also standard risks to supply chains and distribution and sensitivity to tariffs, tax laws, global trade policies, and instability and volatility in global markets. There is also acquisitions, since they are an active acquirer of businesses, and business and operations in those businesses could be impacted. If they can't keep their key people, including their CEO, Warren Kanders, or officers and employees get sick or outside of their control, then it can cause an issue to their business. Approximately 22.2% of the company's common stock is beneficially owned by insiders, so it may limit your ability to influence corporate matters. Also, their cybersecurity system's ability may not operate effectively, and this may occur as a result of cyber incidents, viruses, hackers, malware, natural disasters, vendor business interruptions, or other causes. There's also risk from economic sanctions and the conflict between Russia and Ukraine. Now, let's take a look at those financial results. For the year that ended December 31st, 2024, sales decreased 7.6% or $21.7 million to approximately $264 million compared to approximately $286 million from the previous year. The report attributes it to a decrease in sales at the outdoor and adventure segments of $20.5 million and $1.2 million, respectively. Approximately 60% of their sales for the ended year in 2024 were from international markets. They also had an operating loss of approximately $70.4 million, much larger than the loss from last year. Keep in mind that the year had a $45 million of impairment of goodwill and indefinite-lived intangible assets. While these charges are non-cash items, it may cause concern and negative market perceptions. As such, 2024 was really tough. During the year ended December 31, 2024, the company used approximately $7.3 million in operating activities, compared to approximately $32 million provided in the previous year. The company ended the year with almost $45.4 million in cash, compared to approximately $11.3 million from the previous year. The increase was due to an accounting of almost $165 million in proceeds from the sale of discontinued operations, the Precision Sports segment, but this increase is offset with approximately $123 million cash used in financing activities because of the repayment of debt upon sale. The audit committee seems responsible for the day-to-day risk management, and they received regular reports from the management team regarding organizational risk and cybersecurity. The cybersecurity team, which consists of VP of Information Technology, Director of Information Security, and Director of Infrastructure, is responsible for our security controls and process mitigation. One last financial element: they have net operating losses which can be carried forward to reduce taxes in future years, but this is dependent on the tax code and is not guaranteed. Finally, there's a somewhat odd addition to the company's charter to restrict certain acquisitions to help preserve those net operating losses. It may also have an anti-takeover effect. This is done through a rights agreement between Clarus and Equiniti Trust. So what's the takeaway here? Clarus is in the midst of a major transition, selling off their bullets business and picking up other outdoor brands in the hopes of sustainable and organic growth. However, they are facing real headwinds with existing brands and big legal problems. The strength of the brand continues to be solid, and I expect them to improve with the new acquisitions. The management team needs to get past this period with the federal government that is having a negative impact on its goodwill. It should also be noted that a large percentage of the common stock continues to be beneficially owned by insiders. Overall, Clarus has potential, but the road ahead is rocky. If they can manage these risks, there might be room to improve long-term in both the outdoors and recreational market. Thanks for watching. If you enjoyed, please subscribe, like, and comment.